Hey tech investors, are you ready for another roller coaster ride? This is your AI Tech channel, and today we're diving deep into Marvell Technology's upcoming earnings report. The question on everyone's mind, is Marvell poised for a breakout, or are we heading for a crash landing? Wall Street is buzzing with anticipation, expecting a significant jump in both earnings and revenue. But remember, expectations can be a dangerous trap. Let's break down the numbers and see what's really going on. So what are the headline figures? Analysts are predicting earnings of 59 cents per share, a whopping 28.3% increase year over year. Revenue is projected to hit $1.8 billion, up 26.5% from last year. Those are some impressive numbers, no doubt. But the real question is, can Marvell deliver? These expectations are already baked into the stock price. If Marvell simply meets these targets, we might not see much movement. It's all about exceeding expectations to truly ignite a rally. Now, let's look at the estimate revision trend. Over the past 30 days, the consensus EPS estimate has remained unchanged. This might seem neutral, but it's crucial to understand what it means. It suggests that analysts haven't become more bullish or bearish recently. This lack of upward revision could be interpreted as a sign of caution. Are analysts holding back, waiting to see the actual results before committing to a stronger outlook? It's a yellow flag worth paying attention to. This is where things get interesting. We're turning to the Zacks earnings, ESP, or expected surprise prediction. This model compares the most accurate estimate to the Zacks consensus estimate. The idea is that analysts who revise their estimates closer to the earnings release have the most up-to-date information. For Marvell, the earnings ESP is a positive 2.77%. This suggests that analysts have recently become more optimistic about Marvell's earnings prospects. A positive ESP is a strong predictor of an earnings beat, especially when combined with a strong Zacks rank. Speaking of Zacks rank, Marvell currently holds a rank number 2, which is a buy rating. Historically, stocks with a positive earnings ESP and a Zacks rank of 1, 2, or 3 have a high probability of beating earnings estimates. Our research shows that this combination produces a positive surprise nearly 70% of the time. So, based on these indicators, Marvell looks like a compelling earnings beat candidate. But don't get too excited just yet. There's more to the story. Let's delve into Marvell's earnings surprise history. In the last reported quarter, Marvell beat expectations by 7.5%. Over the past 4 quarters, the company has exceeded consensus EPS estimates 3 times. This track record of positive surprises gives us some confidence that Marvell can pull it off again. However, past performance is not always indicative of future results. We need to consider the current market conditions and Marvell's specific challenges. Now, let's talk about the potential pitfalls. Even if Marvell beats earnings estimates, the stock could still decline if other factors disappoint investors. For example, management's guidance for future quarters could be weaker than expected, or there could be concerns about increased competition or supply chain disruptions. Remember, the market is forward-looking. Investors are not just interested in what happened in the past quarter. They want to know what's going to happen in the future. One critical factor to consider is Marvell's exposure to the AI boom. The company's chips are used in data centers and other AI-related applications. If Marvell can demonstrate strong growth in this area, it could significantly boost investor confidence. However, the AI market is also becoming increasingly competitive, with new players emerging all the time. Marvell needs to stay ahead of the curve to maintain its competitive advantage. According to a research paper by McKinsey, the AI semiconductor market is expected to grow at a CAGR of 35% over the next 5 years. This presents a huge opportunity for Marvell, but also a significant challenge. Let's play devil's advocate for a moment. Some analysts argue that Marvell's stock is already overvalued, given its current earnings and growth prospects. They point to the company's high price-to-earnings ratio and its reliance on a few key customers. According to this viewpoint, even a slight disappointment in earnings or guidance could trigger a significant sell-off. This is a valid concern that investors should consider before making any decisions. A contrarian approach is always healthy in investing. Another factor to consider is the cyclical nature of the semiconductor industry. Demand for chips can fluctuate significantly depending on the overall economic climate and the specific needs of different industries. If the global economy slows down, or if there's a decline in demand for smartphones or other electronic devices, Marvell's earnings could suffer. This is a risk that is inherent in the semiconductor business. Investors need to be prepared for these potential ups and downs. Now, let's take a look at the technical indicators. Marvell's stock has been trading in a relatively narrow range over the past few weeks. The 50-day moving average is currently above the 200-day moving average, which is a bullish sign. However, the Relative Strength Index, RSI, is approaching overbought levels, which could indicate that the stock is due for a pullback. Technical analysis can provide valuable insights, but it should not be the sole basis for your investment decisions. It's important to combine technical analysis with fundamental analysis to get a complete picture. I've been scouring analyst reports and listening to expert opinions to get a sense of where the smart money is going. The consensus view is that Marvell is a solid long-term investment, but there are some short-term risks to consider. Some analysts are recommending buying the stock ahead of earnings, while others are advising caution. It's important to do your own research and make your own informed decisions. Don't just blindly follow the advice of others. Let's consider a few alternative scenarios. Scenario 1. Marvell beats earnings estimates, provides strong guidance, and the stock rallies. In this case, you might want to consider adding to your position. Scenario 2. Marvell misses earnings estimates, provides weak guidance, and the stock declines. In this case, you might want to consider reducing your position or even selling entirely. Scenario 3. Marvell meets expectations, but the stock remains relatively flat. In this case, you might want to hold your position and wait for further developments. So what's the bottom line? Marvell's upcoming earnings release is a high-stakes event that could have a significant impact on the stock price. The company has a good chance of beating earnings estimates, but there are also some potential risks to consider. Investors should carefully weigh the pros and cons before making any decisions. Remember, investing is a marathon, not a sprint. It's important to have a long-term perspective and to be prepared for volatility. In conclusion, Marvell presents a compelling, yet complex, investment opportunity. The positive earnings ESP and Zacks rank suggest a potential earnings beat, but investors should remain vigilant about potential risks and market dynamics. Keep a close watch on Marvell's earnings release on March 5th. What do you think? Will Marvell soar or stumble? Let me know in the comments below. Don't forget to like and subscribe for more in-depth tech analysis. Thanks for watching.